Okay, so here's a review of a trade that I took the other day. I will show you guys the live execution arrow so you can see that I actually took this trade and I'm not lying. But in order to understand why I took this trade, we must first look at the hourly chart, and we can see that price took out buy side liquidity right here, taking out Wednesday's high on Friday into these lines, which is a fair value gap from previous price action. So this sets up the framework to potentially look for a reversal pattern on a smaller time frame. If we get that reversal pattern, which I'll explain when I drop down to the lower time frame, then I will feel comfortable entering a short, targeting these lows and going into this range. Now it's a Friday, so I'm not targeting this sell side liquidity on Friday. I just want to see some type of retracement back into the range that was made on Thursday. So looking at the 1 minute chart, you can see this red arrow is where I entered at. The blue arrow is where I bought at. I cannot put these arrows on the chart. This is done by TradingView itself through the broker when you're logged in. So this can't be faked. But moving on to why I took the trade. So this is the buy side liquidity from the hourly chart, and then this is the fair value gap. So we trade through that into the fair value gap. And for the reversal pattern, basically all I want to see is a bearish shift in market structure for this scenario. If we were bullish, so let's say we took out sell side liquidity into a fair value gap that's down here, I would want to see a bullish shift in market structure. Now, what's a bullish shift in market structure? Basically, you want to see it take out what ICT refers to as an intermediate term low. And one form of an intermediate term low is a swing low that is within a fair value gap. This high doesn't touch this candle's low. So that is a fair value gap. Now, the swing low has to reach a minimum of all least consequent encroachment, which is the midpoint of that gap. If you get a swing low that meets that criteria, then that is an intermediate term low. So when we take that out with this candle, this energetic candle, we have now had a bearish shift in market structure after hitting an hourly fair value gap after taking buy side liquidity. Within this price run that makes that shift in market structure, we create a fair value gap. This low doesn't touch this high. So when price went back into this fair value gap, I wanted to short it at 41.86, which is the bottom end of the fair value gap. And as you can see, we consolidated for about 3 minutes, and then price quickly ran to my target. And for targeting, all I did was measure the retracement. So from this low to this high, I found one standard deviation. So basically, if you double this range from this low to this high, you get this target right here, which was 41.70. So that was enough for me for the day. Obviously, the main target was sell side liquidity, but to be profitable, your main target doesn't have to be hit. Obviously, in this case, it does get hit, but just knowing where price is likely to go, which was sell side liquidity, if I go back to hourly chart, that is these lows right here. So remember I said I wanted to see it go into the range from Thursday. So all I needed was to take out this low. So that is this right here. We take out the low, but my target is just one standard deviation. This trade setup was about a 1-to-4 risk to reward ratio. That was enough to me to close out the week. And yeah, that's basically how I like to trade. This is my favorite type of setup, and it happens just about every day. I hope you found this trade review insightful, and I hope everyone has a blessed and wonderful day.